I am absolutely thrilled you're here today because we're jumping right into a comprehensive deep dive investment analysis on one of the most fascinating and, let's be real, polarizing companies on the market right now, Robinhood Markets. Ticker symbol HOOD. As an experienced investor who tracks high-growth stocks pretty religiously, I can tell you that Robinhood's wild 2026 volatility has been an absolute masterclass in market psychology and shifting fundamentals. We're going to break down everything today, from their core business model to the severe headwinds they've been facing, and then cap it off with a rigorous valuation analysis.
So this brings us to the ultimate question we need to answer today. Is Robinhood a screaming buy right now, or is it just a highly overvalued trap? Because think about it, between late 2025 and early 2026, the stock saw a dramatic 54% correction from its peak. But at the exact same time, the company is posting record-breaking revenues and launching entirely new asset classes. It's crazy. To figure out whether this stock is actually undervalued or just priced for absolute perfection, we need to dig straight into the cold, hard data.
Okay, let's dive into this. Here is our due diligence checklist for today. 1. Robinhood's core revenue engine. 2. The bull case for growth. 3. Headwinds in 2025 and 2026. 4. A detailed stock valuation analysis. And 5. Our outlook and investment disclaimer.
Section 1. Robinhood's core revenue engine. Let's take a look at exactly how this company makes its money.
Right, so before we can really debate the stock itself, we have to understand exactly how this financial toll booth operates. Robinhood's revenue is basically built on three main pillars. First up, transaction-based revenues. This makes up about 60% of their total pie. They collect fractions of pennies through payment for order flow, which, incredibly, brought in $2.52 billion over the trailing 12 months. Second is their net interest income, sitting at 33%. They're literally earning interest on a staggering $46.3 billion in parked customer cash and margin lending. And finally, we have that 7% slice, which is their subscription and other revenue driven primarily by the monthly premium users pay for Robinhood Gold.
And this brilliantly illustrates how they built the massive scale needed to make those fractions of pennies actually add up to billions. Starting from the whole pandemic meme stock era, Robinhood experienced just explosive growth. They didn't just add users, they built an absolutely massive network of over 27 million funded active accounts. They essentially captured an entire generation of millennials and Gen Z who were first-time investors, totally drawn in by that simple, mobile-first interface.
Looking specifically at the numbers driving this engine today, we can see where the real volume is happening. Over the trailing 12 months, options trading generated $1.03 billion, and crypto brought in $1.04 billion. That is vastly outpacing their traditional equity trading. But you know, the real gold mine here is Robinhood Gold. They now have 4.2 million subscribers, and that's growing at 58% year over year. That $5 a month subscription creates this incredibly sticky, recurring revenue that helps stabilize their income, pulling them away from the unpredictable swings of daily trading volume.
Section 2. The bull case for growth. Let's look at the catalysts.
So why are some Wall Street analysts throwing out price targets over $100? Well, because the growth catalysts here are just incredibly aggressive. They are actively transforming from a simple trading app into a fully diversified financial super app. First, prediction markets. This has become their fastest growing segment, with contract volume hitting a massive $3 billion just in April 2026. Second, their push into private markets, like those huge rumors about offering SpaceX IPO tokenization. That keeps them right at the absolute center of retail hype. Third, they won the contract to manage the US government's Trump Accounts program, which has already seen 5 million youth accounts opened. That is a massive, built-in pipeline for lifelong customer acquisition. And finally, the SEC eliminated the pattern day trader, or PDT rule, back in April 2026. Removing that $25,000 minimum requirement is a colossal tailwind that will undoubtedly spike day trading volumes and margin lending across their entire platform.
Section 3. Headwinds in 2025 and 2026. The macroeconomic realities.
Now, as objective analysts, we absolutely must weigh those high-growth catalysts against the pretty brutal macroeconomic realities the company faced late last year and early this year. Take a look at this timeline. In October 2025, Robinhood hit an all-time high of $153.86. But then, the macro environment completely shifted. A severe crypto winter set in, and Bitcoin dropped 37% from its highs. Because Robinhood is so heavily reliant on digital assets, their crypto daily average revenue trades, or DARTs, just plunged 44% in January 2026. Then in February, they reported a Q4 revenue miss, hitting $1.28 billion against Wall Street's $1.34 billion expectation. This pressure culminated in April 2026 when Morgan Stanley slashed their price target and downgraded the stock, sending shares tumbling all the way down to around $69. That is a devastating 54% correction from peak to trough.
Let's move to and see how this builds the core tension facing the company today. On the one hand, you've got this incredible platform expansion into prediction markets, UK international accounts, and credit cards. It's impressive. But on the other hand, you've got a really dangerous over-reliance on volatile crypto transaction revenues, super rich valuations, and this fierce new yield war with competitors like Galaxy Digital, who are aggressively coming after retail assets. It's basically a classic battle between rapid innovation and structural risk.
Section 4. Detailed stock valuation analysis. Let's price the risk.
Now, what's really interesting about this is how we actually price that risk. It basically comes down to one crucial metric, a 2.0x PEG ratio. As investors, the price/earnings to growth ratio helps us test whether the market's really high earnings multiple is actually justified by the company's expected growth rate. A PEG of 2.0x tells us the market is absolutely paying a premium here. But to be fair, that is somewhat balanced out by Robinhood's massive 51.6% expected revenue growth. But the question remains, is it actually cheap? Let's compare it.
To ground this valuation in reality, let's compare Robinhood to a traditional legacy competitor like Charles Schwab. While Robinhood trades at that peg of 2.0x, Schwab and traditional brokers often trade closer to a 1.2x peg, depending on where we are in the cycle. This stark contrast shows us just how massive of a premium investors are willing to pay for Robinhood's user acquisition, their crazy engagement metrics, and their ability to monetize a much younger demographic, especially when you compare it to the slower, steadier growth of the legacy players.
Breaking down the broader metrics, we're looking at a company that is, frankly, priced to perfection. The trailing PE is 36.3x and the forward PE is 35.9x. But more critically, look at the EV/EBITDA at 50.2x and a price-to-sales ratio of 15.0x. Just for context, their historical average price to sales is around 10.3x. Now, operationally, they are incredibly strong. I mean, they boast a stellar 82.3% gross margin and a 3.1% free cash flow yield. But buying in at 15 times sales, that means the company literally cannot afford a single execution misstep.
But, as this quote from Top Tier Strategy's 2026 valuation report points out, a single ratio rarely tells the whole story for a fintech company that's evolving into a super app. We can't just look at PE in a vacuum. If Robinhood successfully transitions from a simple trading app to the primary financial hub for millions of users, handling their credit cards, their IRAs, and their crypto, then traditional broker valuations just aren't going to capture their true long-term value.
Section 5. Outlook and investment disclaimer. Looking ahead to 2027.
So the crucial point is weighing these two distinct use case scenarios as we forecast into 2027. In the bear case, if this crypto winter persists, or if they lose that yield war to competitors, we could absolutely see a harsh valuation reset where that price-to-sales multiple compresses all the way back down to its historical average of 10. But in the bull case, Robinhood leverages that massive influx of youth accounts, successfully mainstreams its multi-billion-dollar prediction markets, and captures the total lifetime financial value of Gen Z. If they pull that off, today's premium valuation is going to look like an absolute bargain in hindsight. Now, before we wrap things up, I must state very clearly, this explainer is for educational purposes only. It is not financial or investment advice. The stock market involves significant risk, and everyone should do their own deep research and consult with a certified professional before investing in Robinhood or, frankly, any other company. Which leaves us with one final thought to ponder today. As we watch this company navigate the rest of the year, will Robinhood successfully become the default financial super app of the next generation, cementing its place as an unstoppable fintech giant? Or will rich valuations and the icy grip of crypto winners ultimately ground the rocket?